Hello traders, Rainer Theo here. Today, let's talk about seasonality. Markets often follow predictable patterns. Understanding these patterns can give you a real trading edge. Imagine knowing a commodity tends to rally every February, or a stock index often drops in September. This isn't about predicting the future, but about stacking the odds in your favor. Seasonality is rooted in real-world drivers, like crop cycles or energy demand in winter. Even stock markets have seasonal tendencies, such as the Santa Claus rally. These patterns repeat year after year. By understanding them, you can find opportunities others miss. Let's dive in and discover how to use seasonality as your hidden edge. So, what is seasonality? It's the tendency for a market's price to move predictably each year. These patterns are driven by consistent changes in supply and demand. Think weather, harvests, or institutional behavior. For example, crops like soybeans follow a planting, growth, and harvest cycle. Before harvest, uncertainty can push prices up. After harvest, increased supply often pushes prices down. Seasonality is a probability, not a guarantee, and should be combined with price action and technical indicators. The real power of seasonality is context. It gives you a roadmap for the year and helps you anticipate market turning points. How do you actually find seasonal patterns? Bernstein's approach is data-driven. Start by gathering at least 10 to 15 years of price data for your market. The longer the history, the more reliable the pattern. Next, create a seasonal chart. This averages price movements for each day of the year over many years. The result is a line showing the market's typical path through the year. This highlights periods with strong tendencies to rise or fall. After spotting a pattern, test its reliability. Check how often the market followed the pattern in past years. A strong pattern might work 80% of the time. Also analyze the magnitude. How much does the market typically move during the seasonal window? Calculate average gains, losses, and the largest moves. This helps you set realistic profit targets and stop losses. Bernstein's system is about robust, data-driven trading. It's not just about direction, but about risk and reward. This method gives you a clear statistical edge. The simplest way to use seasonality is the simple seasonal trend trade. Identify a market with a high reliability seasonal pattern. Say, crude oil rallies from February to April in 80% of past years. Don't just jump in on the start date. Wait for price action to confirm the move. Look for a breakout or bullish chart pattern as the seasonal window begins. Once confirmed, enter the trade with a clear plan. Place your stop loss at a logical level, like below a recent swing low. Set your profit target based on historical average moves, or exit at the end of the seasonal window. This strategy is powerful because it combines statistical edge with real-time confirmation. You're not trading blindly. You're using the calendar to find opportunities and price action to execute. The two-step process filters out false signals. Only enter trades with both a historical tailwind and current momentum. This greatly improves your probability of success. Simple, effective, and actionable. That's the essence of seasonal trading. You refine your trades, combine seasonality with specific price action patterns. Instead of just buying on a breakout, wait for high probability candlestick or chart patterns that align with the seasonal trend. For example, if crude oil is seasonally bullish, look for a pullback to support and a bullish engulfing pattern. This adds another layer of confluence: the why, seasonality, the what, trend, and the when, price action trigger. Chart patterns like bull flags or triangles breaking out during a seasonal window can signal explosive moves. Entering on a specific pattern gives you a clear stop loss and often a tighter risk. This improves your risk to reward ratio. Bernstein recommends timing entries within seasonal windows using bar patterns. Wait for the market to pull back and show strength. Buy on dips in strong seasonal periods. This approach is more professional and less stressful. Let the opportunity come to you. Patience is often rewarded in trading. Combine seasonality and price action for maximum edge. Professional traders often use spread trading to capture seasonality with less risk. A spread trade means buying one contract and selling another related contract, often in the same commodity but different months. For example, buy July soybeans and sell November soybeans. This isolates the seasonal tendency like old crop versus new crop dynamics. You profit if the spread widens, even if overall prices fall. The main advantage is risk reduction. Your exposure to market shocks is lower. If both contracts fall, losses on one side are offset by gains on the other. Your risk is limited to the spread's movement, not the outright price. Spread trading is more complex and requires understanding futures contracts and spread charts. Apply the same seasonal analysis to the spread chart. Look for high reliability patterns in the spread's behavior. Bernstein dedicates much of his teaching to these strategies. It's a favorite among professionals for control risk and seasonal edge. Spotting a seasonal pattern is just the start. You need confirmation. First, look for price action moving in the seasonal direction. Higher highs and higher lows for bullish patterns. Breakouts above resistance are key signals. Use technical indicators for extra confirmation, like price above the 50-day moving average or a bullish crossover. Momentum oscillators such as RSI or MAC can show if momentum supports the move. Look for bullish divergence if price makes a new low, but RSI makes a higher low. That's a strong reversal signal. Check the Commitment of Traders (COT) report for smart money positioning. If commercials are buying in line with the seasonal trend, that's powerful confirmation. Combine these signals for a high probability setup. Never trade on the calendar alone. Wait for the market to confirm. This disciplined approach filters out weak trades. Confirmation is the key to successful seasonal trading. Let's put it all together with a real example. Gold. Gold often rallies from late December to late February, driven by factors like Chinese New Year buying. Historical data shows this pattern works about 75% of the time. As December approaches, don't just buy, watch for confirmation. If gold is consolidating, look for a breakout above a trend line or a double bottom pattern. Add confidence with indicators: MACD crossing above its signal line, RSI above 50 when all signals align, seasonal tendency, price action and momentum. You have a high confluence setup. Enter long, place your stop loss below the recent swing low. For exits, you can use a time-based approach, close the trade at the end of February, or use a trailing stop to lock in profits as price moves up. Alternatively, set a profit target based on the average historical rally. This structured process turns a general tendency into a specific actionable trade. You're trading with a plan, not just a hunch. That's how you use seasonality for real results. Gold's seasonal pattern is just one example. Apply this process to any market. To wrap up, seasonality isn't a magic formula. It's a powerful layer of analysis. It gives you a roadmap and helps you anticipate market moves before they're obvious. By knowing historical tendencies, you're better prepared when other signals align. The key is to combine seasonality with technical analysis, price action, and risk management. The seasonal pattern tells you when to look. Your other tools tell you if it's time to act. Start by looking at monthly charts for repeating patterns. Test for reliability, then incorporate these strategies into your trading. Trading is about probabilities, not certainties. Your job is to find situations where the odds are in your favor. Bernstein's blueprint helps you identify historical tailwinds. By integrating these principles, you become proactive, not reactive. Use the lessons of the past to navigate the future. That's the real power of seasonality in your trading journey.